Analyzing a cash flow statement is essential for understanding a company's liquidity, financial health, and overall performance. Here's a detailed 10-step guide on how a financial analyst can analyze a cash flow statement. Understand the structure. Begin by understanding the structure of the cash flow statement, which is divided into three main sections: operating activities, investing activities, and financing activities. Each section provides insights into different aspects of cash flow. Evaluate operating activities. Examine the cash flows from operating activities, which show the cash generated or used in the company's core business operations. This section includes net income adjusted for non-cash items, like depreciation, and changes in working capital, such as accounts receivable, accounts payable, and inventory. Positive cash flow from operations indicates a company's core business is generating cash. Analyze changes in working capital. Assess changes in working capital components. An increase in accounts receivable might suggest that the company is having trouble collecting payments, while an increase in accounts payable could indicate the company is delaying payments to suppliers. Significant changes can impact liquidity and operational efficiency. Review investing activities. Look at cash flows from investing activities, which include cash spent on capital expenditures, investments in other companies, or proceeds from the sale of assets. Negative cash flow in the section is typical for growth-oriented companies investing heavily in their business. However, large negative amounts without a clear strategy may be a red flag. Examine financing activities. Analyze cash flows from financing activities, which include cash raised from issuing stock or debt, and cash used to repay loans or pay dividends. Positive cash flow in this section often indicates the company is raising funds for expansion, while negative cash flow might suggest repayment of debt or dividends to shareholders. Compare net cash flow. Calculate the net change in cash by summing the cash flows from operating, investing, and financing activities. This will give you the net increase or decrease in cash over the reporting period. Consistent positive net cash flow suggests healthy liquidity, whereas consistent negative cash flow might be a cause for concern. Assess free cash flow. Determine the free cash flow by subtracting capital expenditures from cash flow from operations. Free cash flow represents the cash available for distribution to investors, paying down debt, or reinvestment in the business. Positive free cash flow is a good indicator of financial health. Check cash flow adequacy. Evaluate whether the cash flow from operations is sufficient to cover capital expenditures and debt repayments. If a company relies heavily on financing or investing activities to cover its operational cash needs, it may face liquidity issues. Analyze trends over time. Compare the current period's cash flow statement with previous periods to identify trends and patterns. Consistent improvements or declines in cash flow from different activities can provide insights into the company's operational efficiency, investment strategy, and financial stability. Review the cash flow statement in context. Finally, place the cash flow statement in the context of the company's overall financial performance. Correlate it with the income statement and balance sheet to get a comprehensive view. For instance, compare the cash flow from operations with net income to assess the quality of earnings. By following these steps, a financial analyst can gain a thorough understanding of a company's cash flow dynamics and make more informed judgments about its financial health and operational effectiveness.